Strategy Management Series. Video number 86, Strategy Formulation. Step 7, Strategy Evaluation, Competition Analysis. Welcome back to the Ready MBA series on strategy management. We're currently exploring strategy evaluation, the 7th step of the strategy formulation process, using the Strategy Choice Cascade framework. In earlier episodes, we discussed the 2nd step of the framework, where the planning team determines the where to play aspect of the strategy by defining target customers, industry scope, products, and distribution channels. In this episode, our focus shifts to understanding competition's role in shaping the market. We'll employ Michael Porter's 5 forces analysis to uncover these dynamics. Understanding internal industry rivalry is crucial for market players. It offers insights into competitive dynamics like price wars, aggressive marketing, product innovation, and strategic alliances. Competition significantly impacts industry attractiveness, and mapping it effectively helps identify profitable niches and segments for executing strategies. In industries where rivalry is fierce, competition can be relentless and harsh. Many factors play into this intensity, including the number of competitors, industry growth, lack of product differentiation, industry exit barriers, capacity levels, perishability of goods, and commitment to the industry. This creates a battleground where companies fiercely compete for dominance. When there are a lot of competitors or they're all about the same in size and strength, they all fight fiercely to get more customers and market share. This makes the competition very crowded and aggressive. In slow-growth industries, competition intensifies as companies vie for a larger market share. Limited opportunities for expansion prompt aggressive tactics to maintain competitiveness and survive. These strategies include 1. Price competition. Companies engage in price wars, slashing prices to attract customers, often below average cost. Price wars are more likely to erupt when products or services are nearly identical, fixed costs are high, and marginal costs are low. In such scenarios, cutting prices below average costs becomes tempting, even necessary, to attract customers and cover fixed expenses. This undermines profitability and shifts focus away from product features or services. 2. Product innovation. Heavy investment in research and development creates innovative products or services to stand out from competitors. 3. Marketing and advertising. Aggressive campaigns increase brand awareness and attract new customers through various channels and promotions. 4. Expansion into new markets. Companies enter new geographic areas or target new customer segments to diversify their base and tap into growth opportunities. 5. Acquisitions and mergers. Growth is accelerated through acquisitions or mergers, enhancing market share and competitive position. A lack of product differentiation leads to higher industry rivalry, as companies compete mainly on price. When products or services are similar, customers choose based on price rather than features, prompting aggressive price-cutting strategies to attract customers. Without unique features, companies focus solely on price, intensifying rivalry and reducing profitability for all players in the industry. Exit barriers make it hard for companies to leave an industry, even if they're not doing well. These barriers can include investments in specialized assets, long-term contracts, high exit costs, or emotional attachments to a business. When exit barriers are high, companies feel stuck in the industry, leading to increased internal rivalry. 1. Intense competition for market share. With high exit barriers, companies are forced to stay and compete fiercely for market share. This can result in price wars, aggressive marketing, and innovation battles as companies fight for dominance. 2. Resource drain. Companies may keep investing in a declining industry, draining financial resources as they try to turn things around. This intensifies competition for scarce resources, fueling internal rivalry. 3. Lack of innovation. High exit barriers discourage companies from innovating or trying new strategies. Instead, they focus on defending their market position, leading to strategic stagnation and increased rivalry. 4. Resistance to consolidation. High exit barriers make it hard for companies to merge or exit, prolonging industry fragmentation and rivalry. Overall, exit barriers increase internal rivalry by trapping companies in challenging market conditions, intensifying competition, draining resources, hindering innovation, and resisting industry consolidation. Companies need to carefully assess exit barriers and develop strategies to navigate them effectively. Additionally, rivals' unwavering dedication to their businesses and aspirations for industry leadership fuel the flames of rivalry. Each player is determined to outshine the others, driving them to constantly one-up their competitors. Furthermore, a lack of familiarity among competitors or divergent goals makes it difficult for firms to interpret each other's signals accurately. This adds a layer of unpredictability to the competition, intensifying the struggle for supremacy. Industries with large capacity expansions, perishable products, or overcapacity often resort to price cutting due to economic pressures. 1. Large capacity expansions. In industries like manufacturing or energy, companies face hefty fixed costs when expanding production capacity. When demand stagnates, they may cut prices to attract customers and offset fixed costs, leveraging idle capacity. 2. Perishable products. Industries with perishable goods like food or fashion must manage inventory to avoid losses. If demand drops, they may lower prices to sell excess inventory, preventing losses from unsold goods. 3. Overcapacity. Sectors with surplus supply may slash prices to stimulate demand and clear excess inventory. Overcapacity can result from factors like excessive investment or market saturation, leading companies to use aggressive pricing to maintain market share and avoid inventory buildup. Lower prices can also attract customers in competitive markets. It is important to mention that not all competition spells doom and gloom for industries. When players compete on dimensions beyond price, such as product features or customer service, it can actually enhance customer value and support higher prices. This shift from zero-sum to positive-sum competition benefits all players, increasing the average profitability of the industry. In essence, while rivalry may be inevitable in fiercely contested industries, strategic differentiation and a focus on value creation offer a pathway to sustainable success and profitability. Mapping competition and internal industry rivalry provides valuable insights for the planning team. 1. Identify threats and opportunities. Analyzing industry rivalry helps companies anticipate competitive threats and identify opportunities to gain an advantage, enabling them to adapt their strategies accordingly. 2. Assess competitive positioning and identify attractive niches. Understanding competition allows companies to evaluate their position relative to others. This assessment not only helps in identifying strengths to leverage and weaknesses to address, but also enables the identification of attractive niches for existing and new products. 3. Inform strategic decision-making. Insights from analyzing rivalry inform strategic decisions, guiding resource allocation and differentiation strategies. 4. Anticipate market trends. Understanding industry rivalry helps companies anticipate market trends and emerging threats or opportunities, enabling proactive positioning for success. Understanding industry rivalry is essential for companies to determine where to play. By grasping the competitive landscape and analyzing competition, businesses navigate market intricacies, defining their competitive arenas. This includes where they offer products and services, operational conditions, and the necessary attributes for successful strategies. Keep in mind that industry boundaries are shaped by both product scope, or consumer needs, and geographic scope. By adjusting these dimensions, the planning team can impact the level of industry attractiveness and market competition. This flexibility allows them to discover intriguing niches and segments for strategy execution. And this concludes our episode about competition analysis as a support tool to define and articulate industries where to compete. Please be sure to check our next episodes where we will continue to detail the "where to play" step of the strategy choice cascade framework. Until then, keep strategizing. See you soon.